Well, the title of the piece I wrote was The Rasputin Effect because, like Rasputin, stabbed, shot, poisoned, and drowned, the U.S. economy is still kind of hanging in there. We thought that
Welcome to the Macro Sunday podcast. My name is Andreas Steno. I'm the founder and CEO of Steno Research, and this is your independent macro podcast, released each and every Sunday all year round. We aim at being actionable towards the end of the show every Sunday, but as a broad disclaimer before we get going, you ought to remember that our trade ideas may be...
Sometimes may be good, sometimes may be shit.
Sometimes maybe good this week, Emil.
Yeah, that's pretty good.
Good to see you again, Emil, head of research here at Steno Research.
Butthead reporting for duty.
Yeah, exactly. Yeah. Beavis here. Emil, is the labor market finally crashing in the US? That's the headline of the week. And we're basically punching above our weights when it comes to the guest booking of the week.
Oh, definitely on the last one. On the first one, I wouldn't say it's crashing, but it's definitely declining. And well, here's a thought for you. The Fed didn't manage to control inflation while it was accelerating.
Yeah.
Do you think they will manage to control the labor market when inflation is crashing?
Let's see.
Yeah, I'm a bit skeptic.
They haven't got the best of track records, at least if you look at the past few years here. In 10 minutes' time, we're completely overwhelmed and honored to be able to introduce Michael Cembalest to the podcast, chairman of the market and investment strategy for J.P. Morgan Asset Management, a heavyweighter.
Definitely.
And we'll get his take on the resiliency of the U.S. economy and the labor market. But if we look at the evidence this week, Emil, from the labor market, What's your take on everything from the slide in job openings that we've seen to the challenger job cuts today?
Well, I think my fundamental thesis is starting to play out. That's basically my main takeaway. I think the service sector will be the leading one when it comes to the easing of the job market, and I think that was the first domino. I think there will be more to come, but I'm not predicting, and I've stated this a couple of times, I'm not predicting a complete doom here, but I think we will see a recession in Q1. That's my main takeaway. I'll be curious to what Michael thinks.
And that is no longer the consensus.
No. I'm on my own here.
More or less. More or less.
Yeah.
But Emil, the big question is whether the labor market will get so soft that you need to take alternative methods into use if you want a job. So here's a commercial from Pepsi from a few years ago on that exact topic.
Brilliant.
Mr. Goodman. What makes you think you're qualified for this job?
Oh! No! Stop punching me! Please, stop!
Not the fish.
Don't touch me! Don't throw me out!
That's pretty much how I got this job.
Here it is, huh? Get
it? Do you remember that commercial?
No.
I gotta love it. But Emil, if we look at the data on job openings this week, a slide from, was it 9.4 million to 8.9 thereabout? Such a sequential move would typically mean that we're in a recession.
Yeah.
But if we look at it in nominal terms, we still have 1.5 jobs per unemployed in the U.S. economy, at least if we take that job openings number at face value.
Yeah, which you probably shouldn't given the revisions lately, right?
No, that's one thing, and you don't know whether they double count.
Yeah.
But what do you make of the recession risk short term? I mean, we need more destruction to get there, right?
Oh, absolutely. And I think was it Daria Perkins who said this, that this is not fundamentally a cycle, it's just a distorted economy. And I think that's sort of that makes sense in this whole discussion here. I think he's broadly speaking right. And I think that it's completely possible that many of the usual gauges and leading indicators and whatnot when it comes to the labor market would essentially just misguide you. But yeah, I think we are heading towards a slide in the labor market. I think companies are essentially just giving in slowly but surely.
Yeah.
That's my main take here. So yeah.
The interesting thing, if you watch the Challenger job cuts survey this month, is that we now see announcements of layoffs in sectors related to services, healthcare, retail, stuff like that. A sharp contrast to what we saw earlier this year, where layoffs were announced in manufacturing and technology mainly. So it's a big shift from interest rate sensitive sectors to now labor cost sensitive sectors. So do you think the wage growth is now too high for the economy to cope with? Is that basically the takeaway here?
Yeah, that is basically the takeaway here. I think the service sector is getting squeezed on two sides, right? On one hand, there's the wage component. The other thing is the outlook for demand, and I think a lot of the service sector, a lot of the like small mom and pop stores, let's say, right? They're starting to feeling the heat from the interest rates as well. So there's a financial aspect here going on as well. So yeah, I think it's all slowly but surely paying out. And well, it's been my base case for a couple of months, as you well know, that I think the service sector will essentially be the first domino in the labor market. And well, here I stand.
Emil, you wrote a so-called nugget for us earlier this week on the relationship between the labor market and the housing market. We've seen what you could probably label as green shoots in the housing market from the early spring and over summer. But we are now seeing early signs of a rollover again. Is that related to the service sector as well?
Yes and no. I think there's a bit of a recency bias, and perhaps it's also a generational thing, right? You and me, we grew up in the wake of the great financial crisis, which basically was, well, I don't know if I can use the word, but a clusterfuck taking place within the financial system, right? And it basically just pulled the rug beneath the entire housing market. And usually when we see signs of stress in the pipeline and whatnot, we see market reacting to it first. And I think this time around is basically in reverse. So because everyone and their mother is locked in at really low interest rates, they have equity and they're not losing their jobs. So the housing market is just quite steady, everything concerned, everything considered. But now when the service sector starts to really implement layoffs, and we start to see signs of it, people won't be able to pay their bills, and given that the volume in the housing market is as low as it is, it essentially ends up becoming like a doom loop. Doom loop. That's sort of my point in that nugget, and I think it's
So the labor market will lead the housing market and not vice versa this time.
Exactly.
Around. I think that's a decent theory. Let's see whether it plays out as you.
So I'm no Cassandra, but sometimes I hit it.
Exactly, and this golden handcuff syndrome is one of the main topics for our discussion with Michael Cembalest, the chairman of Market and Investment Strategy for J.P. Morgan Asset Management. He wrote a piece called The Rasputin Effect, explaining global and economic market resilience in the face of the fastest central bank hiking cycle on record a few weeks ago. So let's discuss this with Michael. And as per usual, we introduce our guest of the week with a piece of music. And given the title of his research, chairman of Market and Investment Strategy for J.P. Morgan Asset Management, to the Macro Sunday podcast. A great honor to host you, Michael. Thank you very much for joining us.
Thank you.
Hi. Michael, we are recording hot on the heels of a week with a bit of weakness in the labor market numbers out of the U.S. economy. I think just a few weeks ago, you wrote a story on the impressive resiliency of the U.S. economy, given the backdrop of interest rate hikes of a magnitude that we haven't seen in decades, and also a tendency towards a slowdown globally. So what do you make of the current macro backdrop, given the numbers that we've received this week and the resiliency that we've seen in the U.S. economy over the past quarters?
Yeah. Well, the title of the piece I wrote was The Rasputin Effect, because like Rasputin, stabbed, shot, poisoned, and drowned. The U.S. economy is still kind of hanging in there. We thought that we would see a slowdown this fall. We were kind of on the fence about whether there'd be a recession, but the resilience that we're seeing now is a step greater than we had anticipated. Most of the leading indicators that we follow are still kind of punching away and pointing to weakness in Q4 and Q1, but we bucket them into kind of red, yellow, and orange, and most of them are yellow, right? So they're weakening. They're not pointing to any kind of catastrophic decline. We have a library of around 20 of them that we follow, and most of them are looking out 6, 9, 12 months. 3 or 4 of them were inspired by the research that your team has done. So, so that's how things look. One of the things that really drove me to write this piece is so many clients, either institutional or individual clients, ask me the same question again and again about the papal infallibility of the inverted yield curve. And so I kind of started out by saying, well, it's true. There is papal infallibility about an inverted yield curve historically, but there's a bunch of other things that were going on when those yield curves were inverted that's not happening today. And I think people have paid too much attention to a single factor inverted yield curve and not enough attention to all the other things that were going on at the time.
If you look at the U.S. economy right now and the sensitivity to interest rate hikes, what has changed since the sensitivity seems to be lower now than it was, say, 5, 10 years ago?
Yeah. Well, not just that. I mean, all the post-war era shows you that when rates go up, you see a kind of serious increases in both delinquency rates and interest as a percentage of interest paid as a percentage of corporate profits. That's not happening now. And it's not even happening to any great degree with households. I think who didn't get the memo during 10 years of financial repression that you should lengthen the duration of your liabilities? The only people that I've seen during this whole cycle that didn't get the memo were the inexperienced asset liability managers at Silicon Valley Bank and First Republic and places like that. They were extending the duration of their assets at the lows and rates. But I think, when you look broadly speaking, whether it was the Treasury or the corporate sector or households, most people took the opportunity to extend their duration. The average coupon rate on all outstanding U.S. mortgages is 3.5%.
Yeah.
So high interest rates is not great for kind of contemporaneous housing starts and housing activity, but it's not really creating much of a delinquency dent. I was at a meeting yesterday with the people that run our consumer bank, and we bank 60 or 70% of the households in the United States. The only really ugly number in their entire portfolio is subprime auto. And subprime auto, all you need is even the whiff of economic weakness and it blows up. But it's only around 20% of all auto lending. So, that if that's the worst thing that's going on right now with respect to household credit risk, it's not that bad.
If we look at the leads and lags between monetary policy and the subsequent moves in the economy, do you think it's fair to assume that the lags are just much longer now than in previous cycles?
They could be, because the time that, when I joined J.P. Morgan, this is an anecdote, but I think it's illustrative. When I joined J.P. Morgan, the Mexican government, as an example, the longest duration paper that they could issue was 365 days CETES paper, right, in the local currency. And now there's a 30-year swappable CETES yield curve. Every entity of every kind has had access to longer and longer duration liability issuance. And if that's the case, it takes a longer period of time for higher rates to end up affecting everybody's balance sheets. The other thing too is that the other big buyers of duration are state and corporate pension plans and endowments and foundations. And, they're certainly hurt by rising rates, but even they have been lightening up after a decade of financial repression on the size and duration of their fixed income portfolios. So, it was such a barren landscape in fixed income for so many years that I think the only entities that still owned it in kind of normal sizes and durations were insurance companies that had to do that for regulatory reasons. So I think that's one of the reasons why the lags are a little bit different this time.
Mm-hmm.
I want to make one more. I just want to make one more comment too about the inverted yield curve. What people are misunderstanding too, when the yield curves were historically inverted, it's because the short rates were significantly positive in real terms. That's what was going on. The yield curve was inverted because the Fed would hike the crap out of the policy rate and bring it to a level that was significantly above inflation. This time around, whether you're using forward-looking inflation or trailing empirical inflation, all the Fed has done is gotten back to even. So this inverted yield curve is not necessarily a super restrictive policy rate yet.
No, it leads me to a question on the difference between nominal rates and real interest rates, because that's essentially what you refer to here. If you look at the current monetary policy in real terms, the policy is not necessarily as tight as you could envision, right? So what do you make of this difference between nominal and real in the context of the subsequent spillovers to the economic momentum?
Yeah, I mean, I think that's exactly it. So whenever we show people the inverted yield curve, we show people what real rates were using trailing inflation. You could also use, University of Michigan inflation expectations and things like that. But it's the Fed has kind of gotten back to neutral policy rates. We're not very restrictive right now. I mean, it's kind of amazing, but it shows you just how far behind the curve they got, that after 500 basis points of tightening, we're kind of in a neutral-ish real rate environment. And, the other amazing thing is that Labor Day 2021, the Fed was projecting one hike over the next 12 months.
Yeah.
And before that, they were expecting hikes every year that never happened. And for that, they all won a Nobel Prize, which is kind of remarkable.
Yeah, it is. I'd like to get your take on the current economic consensus for 2024. We track the economic consensus among economists for US GDP growth in quarters ahead. And as far as I can see, we now have no quarters being Q4, Q1 next year, Q2, Q3 next year, with negative growth penciled in the economic projections. Is that a wrong assumption, or how do you view that, given that we've basically been chasing a recession in the economic consensus forever, it seems?
Yeah. What's changed? You know how people criticize management for being very short-term focused on the next quarter's earnings and not planning? The economics industry has changed too. And with better high-frequency tools, I can certainly say this about the economists. I'm not an economist. I'm the chief investment officer. I'm an investments guy, but I pay a lot of attention to the economists that we have inside J.P. Morgan and on the street. And they have better access now to all sorts of high frequency data. And they spend the bulk of their energy on these things called nowcasters. You've probably seen them, where they're trying to track GDP in real time, in the same way that in China, we look at port traffic and electricity consumption and things like that. And if in the past, the average Wall Street economist spent half their time on their long-term economic estimates, I think it's probably now a quarter. And 75% of the effort is on the kind of near-term current quarter or maybe next quarter tracking. So when I see the benign forecasts that you're mentioning for 2024, I'm not sure how sharp those pencils were in terms of what those forecasts are. And I think there's a lot and they're heavily influenced by the fact that the current quarter's data looks better than it otherwise might.
Mm-hmm.
That was a long answer to a short question, but I don't think I would read that much into it. Which means that if you do get some kind of shock, the markets are going to be less prepared for it.
Mm. We've noted a growing divergence between the economic impulse in the service sector and the manufacturing sector. And the most recent evidence that we've gathered from the regional PMIs in the manufacturing sector basically points to some sort of a rebound now amidst what looks like a slowdown in services. So basically upside down given what we've seen over the past 3-4 quarters. Yeah. I'd like to ask an investment guy, not the economist within you, but the investment guy within you, how do you allocate in a scenario where manufacturing rebounds but services slide?
Yeah, well, I mean, it's not hard to do. The challenge is you'll end up with a much more cyclical portfolio that is drifting away from the benchmarks that you manage against. And so it's easy enough to engineer with all the factor modeling that we do when we pick stocks and sectors and countries. The issue is what kind of tracking error are you introducing into the portfolio? And remember, most mutual funds and almost every institutional separate account have tracking error mandates that kind of guide the clients to how much the performance is going to deviate from benchmark. So that's the challenge for positioning for what you're talking about. What I think is driving it is, for the first time in 50 years, the United States has an industrial policy. And we, the average U.S. Chicago-trained economist used to make fun of the Japanese and the Europeans for all of their efforts in industrial policy, and all of a sudden, the United States has said, "Well, the hell with that. We'll have one of our own." So, the battery manufacturing renaissance, or whatever you want to call it, is in full swing from Georgia all the way up to Michigan, and those are some serious numbers. The Chips bill is starting to kick in. I'm a little bit more dubious about how long it's going to take for us to develop some semiconductor independence. And then the infrastructure bill. So you're actually starting to have meaningful numbers of capital spending taking place. And, if that's the case, you would expect within some period of time for the services to catch up.
It leads me to the discussion on fiscal policy. We've touched upon monetary policy a lot in this interview so far, but fiscal policy is obviously important as well. And we've had a whole pamphlet of legislative introductions in the US over the past year, everything from the Inflation Reduction Act to the Chips and Science Act, etc. So how important is the industrial policy of Biden for this cyclical upswing and the resiliency that we see in the US economy right now?
Yeah, I mean, that's the dirty secret of this kind of economic resilience is right now the budget deficit in the US is not that far off from the peak budget deficit in 2008, 2009. So, I mean, the administration talks about its industrial policy as being self-funded through tax increases, hiring of IRS agents, and all sorts of other chicanery. But on a real world basis, they are running mega large deficits to accomplish a lot of this stuff. And since there are no more real fiscal conservatives in the GOP, off they go. So as much as it's tempting to look at the economic resilience in the U.S. as entirely organic, there's a big chunk of it that's coming from very loose fiscal policy, and it's always one generation ahead. And I hope to be retired before we have to deal with it. But by 2032 or 2033, 100% of U.S. tax revenue at the federal level will be consumed by entitlements plus interest. So there won't be any money left for non-defense discretionary spending or defense spending either. So that day is coming. And
that's the congressional budget office you're referring to here, the projection, right?
Yeah, we also work with the what's amazing about government is when people are in office, they're very timid about things. And then when they retire, all of a sudden they get an enormous amount of courage. So there's a bunch of Republicans and Democrats that have left office and are now part of something called the Committee for a Responsible Federal Budget. And they're very concerned about all this, but of course didn't say that much when they were in office. But they do some excellent work, and some of our numbers are derived from their projections as well.
Okay. Thank you.
If we look at the world right now, Michael, we've talked a lot about the U.S. economy, and thank you for that guided tour around both monetary and fiscal policy. But I'd like your brief take on everything that's ongoing in China and Europe. I mean, the deindustrialization of Germany seems imminent, and China is stuck in a complete disaster in terms of the real estate market. So what do you make of the global impulse right now for the economy?
Yeah, I write a big energy piece for the last 15 years or so, and obviously we spent a lot of time on Europe and in Germany, and there are some pretty scary quotes from some manufacturing unions about the risk of Germany becoming an industrial museum. Europe kind of survived last year. Survived the winter and the spring better than a lot of people, including me, thought they would. But then when you decompose the reasons for it, yes, there were some LNG import facilities that were built, and yes, there were some additional pipeline flows of natural gas from other places. But the single biggest factor in terms of BTUs was the belt tightening that took place, just reduced consumption. Yes, there was a little bit of an acceleration of wind and solar implementations and things like that. But Europe last year was a guy that weighed 180 pounds that lost 40 pounds. And now he's 150. So it's healthy to go from 190 to 150. To go from 150 to 110 is not healthy. And in other words, I don't think Europe will be able to recreate next year what they did last year. Without paying a bigger economic price. And we'll also have to obviously see whether or not we get another one of the warmest winters on record. So, we'll see. I mean, certainly, there are certain aspects of the renewable transition that are accelerating, but not quickly enough to displace all that gas. In terms of China, China is one of those places where every time we analyze it, we learn new things that we learn new bad things that we didn't know before. Obviously we have a big China team. We do a lot of China research, but one of the things I hadn't noticed was China's home ownership rate is over 90%. Even in the wildest fever dream of the U.S. FHFA, which is constantly trying to boost home ownership, they never even got to 70% in 2007. So by the time your home ownership rate is over 90%, there's not a lot of policy tools that you have left once you've maxed out on that sector and its contribution to municipal tax revenue by land sales and all that kind of stuff. So, most of the data that we're seeing in China, we look at real activity rates that kind of measure all sorts of things that can be more easily empirically observed, and then transfer fees earned at the municipal level, floor starts. It looks pretty tough, and even if you look at things like the value of the housing stock relative to overall personal consumption in China, it's about 3 times what that is in the U.S. And direct real estate activities as a contribution of GDP, 3 times what it is in the U.S. Home price to income ratios, 4 times what they are in the U.S. So
it's magnificent, isn't it?
yeah. I mean, it's there's not a lot of magic bullets, and it seems like the government is not going to try to bazooka their way out of it the way that Europe and the U.S. There's no Marco. I think there's no Mario Draghi running around China advocating for that kind of solution.
No. I think you're right, Michael. It was a tremendous pleasure to host you here at the Macro Sunday. Michael, thank you very much for being with us. Michael Cembalest, the chairman of Market and Investment Strategy for J.P. Morgan Asset Management. Thank you.
All right, great. Have a good day. Bye.
Cheers.
back from the interview with Michael Cembalest.
Yeah.
What a great guy.
Yeah. Oh, yeah, buzzing.
And as you can hear, client of ours.
Yeah. Yeah.
Not revealing too
That
much.
too.
Very, very kind of him to also acknowledge our research as part of his decision-making process.
We take it.
Yeah, we do. Punching above our weights here.
Definitely.
And we weigh a lot, as you can see, those of you watching on YouTube. So heavyweight in physical terms, at least.
Definitely.
But Emil, I'd like to conclude with a discussion on what matters most for markets right now. And I mean, we've had discussions on energy over the past couple of weeks, also given inventory draws in crude and whatnot. And as Michael Cembalest also alludes to, if I'm right that manufacturing actually rebounds here, you basically need to tilt your portfolio in a cyclical direction. And that will still, I think, lead to a lot of people being wrong-footed out there.
It's definitely a chance for it, right?
Yeah.
I think the big joker here is the role of energy. And I'm sort of fearful that we will see, at least if it remains as resilient as it has for the past couple of months and keeps still going strong, perhaps we see some more supply issues and whatnot, and maybe the Saudis extend their cuts and what have you. I think there's a chance that will feed into inflation expectations and creating a bit of a problem on the long end of the curve. And that could definitely increase volatility as well. That's something to look out for. And I think now here in the wake of the JOLTS opening report, that the market sort of overreacted a bit, and went full risk on, dollar down, blah blah blah, and then we saw a quick reversal. And I'm sort of thinking that perhaps these next couple of weeks, there's a chance that you might find yourself in a trap if you go long beta here. And I've been warning about it since August. 1st of August, I basically said you shouldn't be long any beta exposure, and I think that had aged particularly well. And that's sort of the juncture I think we find ourselves in right now.
And one of the things to look out for is whether we get a new administration in the White House being much more friendly to fossil fuels. And we typically have the soundbite of the week with Mr. Donald Trump, and this week is no exception. So here's Donald Trump on dishwashers and light bulbs.
I brought back the old light bulb. Better light for much less money if you want it. Little. Somebody said, "Oh, sir, don't mention the light bulb." It's hard to make an elegant speech. I'm saying I brought back the light bulb. So the new light bulb costs you 5 times as much, and it makes you look orange. And I was more interested in the orange than I was in the cost. But I'm also approving new dishwashers that give you more water so you can actually wash and rinse your dishes without having to do it 10 times. 4, 5, 6, 7, 8, 9, 10.
Brilliant. Just brilliant.
Anybody have
my
a new
God.
dishwasher? I'm sorry for that.
Traveling salesman at the Prairie here.
Snakes oil.
Yeah, exactly.
But you gotta love it anyway.
yeah.
I mean, it's at least entertaining.
Yeah.
But I mean, let's assume that from a supply perspective, that the current Biden administration continues down the path that it's currently at, and the Saudis continue to cut supply, say, for the remainder of the year. Do you think we have upside left in energy then?
Yeah.
Yeah.
Basically, I think it's also interesting to see what's going behind the diplomatic scene from Washington. We see that they're sort of talking to the Iranians, they're talking to the Venezuelans. I think they're sort of aware that the Saudis are really implementing their leverage on the oil market, and they're trying to, sneak a back way solution to that whole issue, at least on a fundamental basis. But yeah, I think that's something to watch here the next couple of months, definitely.
Yeah. So if we look at our portfolio right now, Emil, we're long commodities, the broad Becom index, we're long energy, we're long steepness.
Yeah.
It is a cyclical bit, isn't it?
It is. We're on that train, definitely. Yeah.
And we caught the trend early in the manufacturing rebound. Now we've seen both regionals and the ISM bouncing as well. So I mean, I think this story's got legs.
Yeah. And I think our entrance was pretty well timed, as you said. So I think we can be satisfied with what we've done here these past couple of weeks, definitely.
So if we set aside our lottery tickets on Winnie the Pooh, finding the bazooka in China, then it's
have something starting to happen right now, right?
It seems like we're. Yeah. I mean, I've labeled it the intervention zone. What we see right now in Chinese real estate prices, and it seems like there is no appetite for them to sort of drop even further. At least.
Yeah.
So I think the floor is at least set short term, isn't it?
Yeah, they tweaked a few parameters here and there, and some rates and what have you. They're not really like committing to an actual uptrend here. But I think you're right. They're establishing the floor. We just thought they would do it a bit sooner, so we were ahead of the curve and we paid for it.
Yeah. Being too early is not.
No. Only gets you in trouble, no matter what.
So always show up late.
Yeah.
Is that the conclusion?
Italians are not that dumb.
No, they're not. You're absolutely right. Emil, once again, a great pleasure to host you here at the Macro Sunday podcast. Remember that this is your independent podcast on macro each and every Sunday all year around. If you want more of our research, you can go to stenoresearch.com and use the exclusive offer for the Macro Sundays audience, Macro 30, to get 30% off your subscription. We run a live portfolio. It's 100% transparent. You get 20 plus articles a week with takes on everything from China to Europe. We haven't even talked about Europe this week. The deindustrialization continues. That's the short.
Perhaps that's a topic for next week then.
Yeah, it could be. And we do our best to be as transparent as we can because that's essentially our doctrine when it comes to the macro research part of it.
Yeah.
With that said, remember as a broad disclaimer that our trade ideas can be.
Sometimes maybe good, sometimes maybe shit.
And then I guess we'll see you again next week. Thank you for watching and listening.
Have a good one.